I think we are just about there. So good morning, everybody. Thank you for joining us for the March edition of our Economic and Investment Update. I appreciate it is a lovely day out there, so thank you for spending a little bit of your time with us today. For those of you who are new to our webinar, I'm David Baker. I'm a Partner and Chief Investment Officer at the firm, and I'm joined as ever by our Chief Economist, George Ligarius from Athens. Usual format, we'll do about 10 minutes just update on markets from myself, and then George will take us through the bulk of the presentation in terms of what's happening in the economies, and we will try to bring those two things together and give you an idea of what we think is happening in the world, and then hopefully we'll have 10-15 minutes toward the end where we can answer some of your questions. So thank you for those people who've already submitted questions. If you do have a question either now or as we're going through the presentation, please do pop that into the Q&A if you could, rather than the chat, and we'll endeavour to try and pick up as many of those as possible. So let's move on then, and let's just have a little look at what's been happening in markets. And here we're just looking at most of March. This is a couple of days out of date, but it's most of March, and you can see again pretty strong returns from equities. And again, similar to previous discussions that we've had, some dispersion between different geographies, and I'll talk a little bit about why that might have been in a couple of slides' time. But suffice to say, sort of moving from east to west is where the best performance has been, at least in the developed markets. Emerging markets have had a struggle during March, but Japan, Europe, and the UK giving you better returns than the US, and that has not been the picture for a lot of 2020. So equities doing rather well. Bonds, it looks as though they're doing okay, trundling along through March, but actually, and again, we'll touch on this as we go through, your bonds haven't had a good 2021 so far. UK gilts down about 6.5%, US Treasury holding up a little bit better, but still down by about 0.5% year to date. And the resurgence that we've seen in commodities, and particular in copper, that has all calmed down over the last month or so. So that's the short term. If we just then look at how equity markets in particular have done over the longer term, there you can see the dark blue line being the whole of the MSCI World Index, and the light blue line, just for context, we put that on excluding the US, which has been the standout market. But nonetheless, in both lines you can see a huge amount of volatility, not least around this time last year when we were in the depths of going into lockdown, and really nobody had any idea what was going to happen economically and how governments were going to respond. And then obviously the big corresponding bounce back when we had furlough schemes, when we had fiscal support, monetary support, and so on and so forth. So a very noisy line over the last 5 years and over the last 18 months in particular. However, if you look on the right hand side of that chart, what you can see is in the more recent times, and by that I mean 2021 year to date, actually equities have been moving fairly sideways for most of this year. And if you take out the first week of the year, which tends to be characterized by investment banks rebuilding their stock inventories, actually really quite sideways. And we've spoken about this at last, probably the last couple of webinars we've done. It wouldn't at all surprise us if we saw equities moving sideways for a period of time. They're pretty much priced to perfection in terms of expectations of how we will all come out of lockdown and how economic activity will resume. So that expectation is there. It hasn't fully happened yet, and we expect markets to move broadly sideways as earnings catch up with the fairly punchy pricing on equities. We are at all-time highs despite the peculiarities of the economic situation. So that's equities. As I said, they are at all-time highs, and if we look at the next chart, then we can see, one of the reasons why that might be. This is something that we look at our investment committee quite regularly. Just how invested are the rest of the market? So one of the key measures is how much cash investment managers, global portfolio managers, are keeping on the sidelines. And you can see that, again, a bit of a noisy chart, but the average is roughly about 5.5% of cash is held in portfolios at any one time. And that now is as low as about 3.6%. And you can see on that chart, which covers the last 10, 11 years, that's lower than it's been in the whole of that period. And what that really tells you, and as we've discussed before, this idea of there being no alternative. We don't want to hold cash, we don't want to hold gilts, we have to be invested somewhere. That's telling you that equity managers are pretty much all in the markets, which in and of itself suggests a bullish environment. But actually, if all of the money is already invested, where is the next money that's going to come behind that to be supportive of further growth? So it just goes to support our hypothesis that we're probably going to see a little bit of sideways movement in markets, all other things being equal. So global equity managers are pretty much all in with their cash. And then in addition to that, you do see, as we've discussed before, elements of bubbly behavior. And the next chart shows a little example of that. The left-hand side, what we're looking at there is the numbers of what are called SPACs, so special purpose acquisition companies, and indeed IPOs. So these are initial public offerings of private companies going to market looking to raise cash. And you can see, particularly with the SPACs, which is the light blue element of that bar chart, there's been an absolute explosion in the formation of these companies who simply look to attract money in order to then go and buy a private company and take it public. So that in and of itself indicates that there's a lot of money trying to find a home. And certainly in the private markets and the hedge fund markets, there is an awful lot of liquidity. Quite interesting to see last week that there was talk of a SPAC being set up specifically to buy WeWork. WeWork, if you remember, was an office space company which sort of masqueraded as a tech company and had some very fanciful valuations on it, supported by investment from SoftBank, and eventually ran into huge difficulties last year. So the fact that that is being talked about as a potential target for a company that exists with no track record but has just attracted money for an unknown investment opportunity does signal that there is a bit of bubbly behavior around that. Then again, on the IPOs today, we've got Deliveroo. We'll find out what price that floats at, and tomorrow the market will be able to trade it, and some quite hefty valuations are on a company that is not making any money, and some people question whether it will make any in the future. Particularly bearing in mind that we've had that judgment on Uber and the fact that their drivers are deemed to be workers and therefore entitled to certain benefits and rights, and a lot of market commentators thinking that people like Deliveroo will have to face up to that similar sort of situation. So notwithstanding the fact that they're not making any profit now, there are potential obstacles down the line for companies like Deliveroo. And interesting to see a lot of big fund managers saying that potential issue around workers' rights is a reason they're going to be avoiding the IPO, not investing in Deliveroo, because they feel it doesn't meet their ESG criteria. So a lot going on in that market. They're not particularly making a great amount of money at the moment, and it wouldn't surprise us at all if we see a little bit of misallocation of capital and quite a lot of this money being lost on the periphery of markets over the next couple of years. So that's a sort of the weird, illiquid private end of the market. Back to the main equity markets, the next chart. And incidentally, we had a question come through on this around growth versus value. So generally speaking, for those of you who are not familiar with those phrases, when you look at equity markets, you can compartmentalize stocks either as being growth stocks, so those that there is an anticipation of a significant rise in earnings in the future and significant growth of the company, and it achieves a valuation based on that anticipated growth. And then value stocks where the earnings and the revenues are pretty stable and established, and the valuation is simply accrued from existing knowledge and existing customer base. And over the last 10 years, growth stocks have really been in favor, growth stocks being the dark blue line on this particular chart. And even more so during 2020 and very much in the first half of 2020, growth, and for which you can probably proxy IT stocks, so the FANGs, Facebook, Amazon, Netflix, Google, had a fantastic performance while value really suffered. And we can appreciate the logic behind that, because as we've all been working and staying at home, the use of technology stocks has attracted a huge amount more revenue. That started to turn towards the end of last year, and particularly when you had announcements around vaccines, and value stocks became much more in favor. So here we're talking about things like energy, mining, banks, which have benefited from an expectation of rising interest rates and an environment that makes it easier for banks to make profit. And then, of course, you've got the other sort of category, which is those stocks, retail and leisure in particular, which have struggled for very obvious reasons, with an expectation that as we come out of lockdown, we will those stocks will increase their revenues and bounce back. Will be interesting to see to what extent that happens, and in particular how much debt these companies have had to take on just to keep going through this period and to get to the point in which they can start meaningfully trading. So that is a big question at the moment about whether you should be switching from growth into value. We have our investment committee on Thursday of this week, and that's one of the questions we will be considering, and I suspect we will continue to shift a little bit more to value and a little bit away from growth, or in particular away from tech. Going back to the first slide, I said it's obvious that Japan, Europe, and the UK and the US, the first three have outperformed the US, and that's probably the reason for that. It's this preference for value, the US with so much in tech, it dominating about a quarter of the S&P 500, and it having done so well. That rotation from growth into value has really meant that geographically, Japan and Europe have been favoured, even though Europe obviously has big challenges around its vaccine rollout plan. So that's the equity markets. Just a final note on the next slide about bond markets, and we talked about this last month, but it's worth reiterating. We are seeing interest rates being pushed up, or rather than interest rates, the yield on sovereign bonds being pushed up, particularly at what we call the long end of the curve. So anything beyond 10 years, you're starting to see the markets wanting to be paid more for holding longer dated debt. And the reason for that is really this expectation of inflation. So we know that there will be some transitory inflation, at least arising from the disruption to supply chains. Notwithstanding the fact that we've had a ship stuck in the Suez Canal for a good number of days, COVID in and of itself brought this disruption to global supply chains, which we thought would be inflation, and we're starting to see a little bit of that coming into the data now, even though the headline data still suggests there isn't any inflation. Input prices, there definitely is. So there is this expectation of inflation. Whether that goes on to be medium to long-term inflation, we'll find out in due course. But that's what's pushing yields up, and you're then left with the question, well, we didn't want to invest in US Treasuries or UK gilts at very low yields, but does there become a point where actually 1.752% on the US Treasury does become an attractive number? And if that is the case, does that mean we'll see switching out of equities into bonds? We don't think that we're there yet. 2% is still a fairly measly return, particularly if you do expect inflation of about 2.5%. You're still getting a negative real return. So that's a canter through what's been happening in markets over the last month or so, and I'll pass to George to pick up on the economics of things.
Thank you very much, David. Um, so, first of all, good morning, everyone, from sunny Athens. What we have in the global economy right now is sort of, it's a very good picture. It is a picture of improvement, but it is really upkept by massive global fiscal stimulus, i.e. governments borrowing a lot of money, specifically from central banks, and then funneling that money to the economy to maintain measures to help people with stimulus. Now, the big question is, of course, for everyone, is what happens when we retract those measures, when we will retract them, how we will retract them, what will the overall policy be, and once we lift that particular veil, what is it that is going on in the real economy? Let's go to the next slide. At this point, still, we do not see any immediate retraction of fiscal policy. I think Chancellor Sunak was pretty clear about this. Right now, what is driving the global economy is the COVID vaccination narrative. Israel is the global champion. The UK is the champion in amongst the G7. You can see the two bar charts. The strong blue one is the situation a couple of days ago, and the light blue one is the situation a month ago. The US is picking up the pace very quickly. So that is the most important economy in the world, roughly 25% of global output or so. And Europe, which is an economy of equal size, or a little bit less now that the UK has left it, is woefully lagging behind. And this will be an issue going forward. Why? Because you need, first of all, you need all of the world to vaccinate very, very quickly. And in terms of, if you look at the whole world, we have vaccinated just 7% of people, which means that the rest of the 93% of the people, not only are they uncovered, but they are potentially little factories within which different mutations of the virus might be developed. It only takes one to create a variant which is resistant to vaccines. So, and this is the big risk. We need to vaccinate the rest of the world very quickly. The IMF, the OECD, everybody says that this should be the #1 priority. And let's face it, unfortunately, we have not been doing such great work at this. In this person's humble opinion, we should have been ready with a lot more productive capabilities much earlier in the year. I think production is going to be is currently ramping up, and we're going to have a lot more people vaccinated by September, October, at least in the developed countries. But still, that leaves everybody vulnerable to mutations. So yes, there is a way out of this tunnel, but it is far from a straight road right now. And obviously, this is causing a lot of desynchronization amongst economies. Other economies are recovering. Others, for example, Germany, Italy, Spain, are locking down again. And this is unbalancing the global supply chain by a lot. Now, in the next slide, what you're going to see is that, having said all that, the OECD, the IMF, and other organizations have improved their projections for global output um, this year. However, this is contingent to vaccination rates hitting particular targets, some of which can be described as ambitious, especially again in the EU. So we expect to see a lot of macroeconomic volatility, i.e. the numbers jumping up and down in the next, still in the next few months. And obviously all this pressure in the global supply chain, all this pressure in financial systems, all these openings and closings cause supply chain issues, so a modicum of supply inflation. And then there is possibly consumer inflation, demand inflation coming up because of all the massive stimulus. Now, in the next slide, what you're going to see is two different tales, and that's just the UK. On the left hand, you can see UK inflation ticking lower, just at 0.4% year on year, and the core inflation at 0.9%. But you can also see on your right-hand side input inflation ticking higher. Now, this does not necessarily translate into consumer inflation. Why? Because companies may very well decide to take a hit on their margins and maintain their market shares, especially in industries where there's no pricing power. So, and if they say, well, okay, fine, but this inflation thing is input inflation thing is just a supply chain disruption which will last a few months, we can take a hit on the margins rather than change prices and risk losing market share. And I think that is a very plausible explanation why we have not seen real inflation yet. But make no mistake, if the rebound persists, and we're going to talk about this in the end, if by some miracle we see resurgent consumers, then we could be looking at inflation for longer. This is not our current thesis, to be sure. Before we entered into this, and in many of the previous seminars, you have heard the term secular stagnation. People's propensity after 2008 to save rather than spend and consume, and that is still what is driving the global consumer, we believe. That does not mean with all that stimulus, especially, it can change, but we're still, much like central banks, firmly in the camp of things won't change much for consumers in the near future. Now, to change tack a little bit, we need to talk about the UK. In the next slide, what you're going to see, especially on the left hand, is the chart that's got everybody riled up. This is UK exports to the EU. They fell circa 40% in January versus December. Now, yes, there is an element of, in the right-hand side, you can see that the trend towards non-EU is very much uninterrupted in the past few months. It was really interrupted by COVID, not by Brexit. So let's focus on the left hand. What does this particular chart mean? First of all, it could be nothing. It could be an effect of a lot of companies having stocked up just before Brexit happened. And then obviously there is no need for many exports, but over time this should normalize, especially as different companies learn to deal with the bureaucracy involved in trade that is not frictionless anymore. And that is very much the opinion we got from number 10. Now, the British Chamber of Commerce says a different story, a story where not necessarily minus 40%, but where sluggish trade between the EU and the UK could possibly hurt the UK economy going forward. We need a lot more data because this is still a 2-3 month thing, Brexit. We need a lot more data, and also I need to remind people that this is still a live thing. There are plenty of issues on the table. There are plenty of agreements, there are plenty of disagreements. See what happened with vaccines. First they disagreed, then they agreed, then they disagreed again, and they agreed again. Okay, this is going to be very much a live debate and a live relationship. In many terms, much more live than it was a few years ago. So I'm not putting all my stock, despite my trust for the British Chamber of Commerce as an independent, think tank of what is happening in British businesses. I'm still not putting all my stock in this one particular explanation. I would like to wait and see how this plays out in the near future. And of course, going on the next slide, you will see that yes, there is trade disruption, surely, but the economy is doing very, very well. The UK pay growth is the highest since the global financial crisis in 2008. And unemployment was actually pushed down. Now, yes, there is still the furlough scheme, so we have no idea if real unemployment is much higher than reported. But still, it's good to remember that stimulus is there. We can't just see it as something, oh, that will pass, and we just need to focus on the disaster ahead. And that's the last issue we're going to touch. So there are three big unknowns which we focus on. Next slide. Now, the first one is the trade relationship with the EU, between the EU and the UK. And as I said, it is a very live discussion between the two parties. They involve vaccines, they involve Northern Ireland, they involve a lot of things. And at the end of the day, I think everybody is pragmatic about things like that. I have no idea how this trade relationship is going to end up, because this game of chess, this particular game of chess, and that's probably what's so interesting about this. You can imagine it as an ongoing game of chess with no real end result. There is no checkmate here, and where the players change over time. There could be a new UK Prime Minister in the distant future. There is going to be a new German Chancellor in the near future. There is an election in September. There could be a new French president if Mr. Macron loses the election next year. So we're going to be talking about a constantly shifting environment. At the end of the day, and I'm definitely not the one to comment on Brexit, but I think Brexit traded at the end of the day, what was traded was stability was traded away in favor of maybe agility. So I'm very interested to see how this plays out. Make no mistake, it could be a world of pain for UK trade, but yes, also that sort of change in conditions could bring about real opportunities. The other unknown in the next slide, as you will see, and that is one of the biggest fears that we have. There is absolutely no upside to this. Is possible hidden unemployment. We know that real unemployment ex furlough is not 5%. We know that a lot of companies, a lot of shops, a lot of restaurants that have been shut for a year may not be able to reopen. There's going to be, at the very least, friction unemployment, i.e. Unemployment as people need to change sectors, they need to find new jobs elsewhere. And it does not necessarily mean that eventually those people will not be absorbed in the job market, but in the meantime, there might be higher unemployment numbers. Now, the government has suggested, albeit not officially, that they were willing to entertain the idea of an extra 4 million unemployed, up from currently 2.5 million unemployed. That would bring total unemployment around 13%, up from maybe 3.8% in 2008. Now, the third unknown is in the next slide is, and that's where I want to keep it, is the resurgent consumer. Um, David suggested, in jesting surely, but that he was at some point willing to just go out and spend a lot of money just to feel better after being cooped up in a year for a year in his house. And surely this is the feeling shared by many. Now, from where we are, there are two possible roads. One, we're back to the 1920s, where people went through through a horrific world war, and suddenly everybody appreciated life, and they were out and partying all day and all night. And something like a global pandemic is a powerful enough incentive. It's a powerful enough, not incentive, it's a powerful enough shock to change consumer behaviors. That would mean that inflation could be resurgent over the longer term. Again, I remind, we're not in that particular camp, but that would mean we could see resurgent inflation. This would mean that the economic and the financial model, which is currently sustained by low interest rates and monetary accommodation by central banks, would have to change. We would surely see a lot of re-rating in terms of stocks and bonds. Re-rating means volatility. It means markets going down for some time. But then that would lead to a healthier economic model down the road. Or if the consumer still is afraid, even if they have more money in their pockets, they're not willing to take it out and spend it, then we could see more of the same, i.e., central banks supporting businesses, and possibly a lot of more helicopter money, i.e., the government borrowing, especially from central banks, to support consumers. And if we do not see any real long-term inflation, there is the possibility that government will continue to print money until they see inflation eventually, to give it out to people. So that all depends on how the global consumer will move. Consumption is about 60 to 70% of all developed economies, and it's always the big unknown when it comes to economic growth. More so today, when the consumer is the focus, because it's the consumer, not the factories themselves, not the assets, not the machines, but the consumers have been locked down and cannot go out and physically spend money and enjoy their lives. So it is a question whether a different sort of consumer, a different sort of human will emerge after we're done with this COVID crisis. As I said, we're still in the camp of secular stagnation. We have no real evidence that would suggest that we're going to see many happy people like the gentleman in the picture. But nevertheless, we must entertain the idea, because it will have significant repercussions for economies, for portfolios over the short and the long term. And with that, I would like to leave you and open it up to any questions.
George, thank you very much indeed for that. I do think, as you know, that consumer psychology is going to be one of the really interesting questions as we emerge from this pandemic. But also, what we've seen in terms of the savings that have accrued to consumers over the lockdown period is obviously not been accrued in a uniform way. You've had some parts of the demography which have benefited much more, and it was interesting yesterday to see that the French are considering whether they ought to give some tax incentives for older generations to pass money down, in particular to grandchildren, because there's an expectancy that the propensity to spend is much greater in younger generations than it is in the older generation. So I think that's going to be a fascinating thing to observe over the next year or so. So we've got 10 minutes to touch on some questions, and again, thank you for sending the questions through, and apologies if we don't get to your question. We will try and follow up by email on all the questions that have come through. I'll take one that's just come through, because you mentioned helicopter money, George. So let me try and combine two questions into one. So one is touching on the US having paid checks of $1,400 to all of its adult population, and you can't get a more crude transmission mechanism for fiscal policy than to simply send people money for which they can spend in whichever way they choose. And connected to that, question that's just come in, can we expect governments of any colour, and I'll extend that to any geography, to pursue inflation as a way to deal with public debt?
First of all, I think governments are less. Any prime minister right now, a governor, president, has less public debt or even inflation in their minds, and they need to help the markets recover from this unique event. Um, and they have a tool in their hands. They can borrow money from their own central banks, especially the big central banks, that is the ECB, the Fed, and the Bank of England. And they can borrow money at very low rates from that their own central bank is going to buy. And this is important. We'll touch on that. And they can go out and just give it to people, which is great if you're a politician because you want to be popular. And the perk of this is that you do not owe that money to, say, external private investors who are going to press you to get that money back if something goes south. You owe it to your own central banks. It's literally like borrowing money from your mom. And that means that there is a very big chunk of debt that if governments, for whatever reason, fail to pay it up, they can always defer it, they can always elongate it, and none is the wiser. Nothing would change much, and no one would default. This is the beauty of modern monetary theory. Now, the added bonus on that is inflation. You can have you can inflate your way out of that debt. The only reason why I'm not certain in answering that is with this particular policy, you're incurring debt to inflate to get rid of the debt. So I have no idea which is going to move faster, the inflation or the debt going up. So that would probably, I'm not sure if it would be a swift way out of debt. But in terms of fiscal stimulus, I think the governments are very incentivized now to keep it going, even after the pandemic is over, and maybe scale it down a little bit, but to keep it going, especially if they don't see long-term inflation coming back. Long-term inflation can topple governments. Make no mistake. If it's above 5% or whatever. Um, but I do see governments finally having discovered the perks of fiscal easing to go along and try to stimulate their economies in a way that's much easier to do rather than just straight out competition.
Thank you, George. And whilst we're on the subject, let me tie in another question there, because I don't think any government is going to admit to pursuing a policy of fostering inflation to effectively pay down debt. And you mentioned fiscal easing, but in the budget that we've had since we last held this webinar, there was quite a significant increase in tax, in corporation tax at least, but not now. And I wonder whether we think, or indeed our tax colleagues think, that that is a pattern that we're going to see. You know my fondness for what I call the 3-year rule. We don't have to fix it today, it'll be slightly better next year, and the third year everything will be fine.
So let let cynical George show up and say that when we say I will give you money today and I will raise taxes tomorrow, especially I think in the year just before a general election, but let's leave that on the side. Um, it's a good way to keep the OBR happy. It's a good way to keep fiscal watchdogs happy. But in political terms, anything can change between now and then, the chancellor included, the government included. So taxes 2 years from now are a probability. Are they high probability? I think if you can borrow again, because you were right to conflate the questions, David, if you can borrow a lot of money from your own central bank, why upset people by hiking taxes and small businesses especially? So I think it is a probability. I don't think it's a 90 or 80% probability. I think personally it's below that. So yes, I would question the government's propensity to raise taxes. I think taxes are more a political tool right now than they are a fiscal tool. I mean, obviously not the taxes themselves. Tax receipts are very important. The change in taxes.
Thank you. Let's change tack and let's switch to a couple of market-based questions. So topical question has come through. Should we be worried about the hedge fund which has just collapsed? So this presumably is a reference to the Archegos hedge fund, which was set up by a successful fund manager as a sort of multi-family office. I did hear this morning that somebody had referred to it not as Archegos but as Arch egos, which, if you've met any fund managers, is rather apt. But I guess the question is, George, it's not very nice for those people and the investment banks supporting this hedge fund, but is it something that might have contagion into the wider market?
Well, first of all, in terms of Nomura and Credit Suisse, it is definitely a hit on the quarterly earnings, and possibly a little further than that because they were the prime brokers, so they had credit lines with said hedge fund. It was a massive unwinding, around 20 billion of positions. So they're definitely taking a hit. Their quarterly earnings are wiped out. But there is a difference between now and 2007, 2008, a situation reminiscent, and that is that there are a lot more safeguards in terms of contagion, in terms of the whole financial system. To be again pretty blunt, the banks have become a lot more boring institutions, which means that sort of contagion which we saw in 2008 has less of a probability, much less of a probability of happening. So the impact of one hedge fund starting a domino like 2008 is probably very far removed, especially when people would consider selling short or just selling everything. Before they did that, they need to consider that the central banks might again intervene and just throw trillions at the problem at very little cost. So people, investors, they would be less willing to start a panic over that. And that probably mitigates a lot of the impact from all of that. So I cannot be sure because I don't know what the underlying relationships are, David, but it does not at this point, and we need to watch for any hedge funds or banks with negative surprises in the near future. But I'm really not that concerned yet. I could be in 10 days, but not based on the data I have now.
Thank you. And I think that's the point, isn't it? It's almost impossible to say because, as you say, we are assured by the regulatory authorities that banks' balance sheets are much more robust and a much more cautious approach being taken. But one never really knows what the interconnectedness of matters is until after the event. But actually, for me, quite interesting to see parallels between the whole GameStop thing, where these Reddit investors, these people sat at home investing on platforms, managed to pump up the price of one particular stock, but then when they got bored doing that and tried to find somebody else to sell it to, the whole thing collapsed. And it's quite interesting to see that fate can befall experienced hedge fund managers as well as day traders. Let's squeeze one final very quick question in, if we could, George. It's a straightforward question. Do you still think, because I think we might have mentioned this last time, that UK stock markets are undervalued compared to other geographies?
Yes. The UK is trading about 5%. Its average. Every other geography is trading 25, and that's the FTSE 100. So the companies least sensitive to Brexit. All of the other regions trade nearly 25% of their averages. So I would say that it's not a bias towards British stocks. It's probably a bias towards higher dividend stocks, but I think that there's a good chance we're going to see the end of that bias sometime this year, especially if bond yields come down again.
Excellent. Thank you, George. And I think we will leave it there because we are just about out of time. So thanks to George. Thank you for Harry for helping us with the technology. But most of all, thank you to you for spending the time with us today. We don't yet have a date for our April webinar, but it will probably be the last Tuesday in April. And we'll communicate that out in the usual fashion in the very short term. So thank you all very much. Enjoy the good weather and goodbye.